When markets crash, most people focus on what they might lose. But crashes do not just destroy wealth, they transfer it. And these are 5 assets that can surge when panic takes over. In September 2008, Lehman Brothers filed for bankruptcy on a Monday morning. By Friday, roughly $10 trillion of global wealth had been wiped out. Pension funds broke, mortgage markets froze, and banks stopped lending to each other. At the same time, hedge fund manager John Paulson was sitting on a $15 billion profit, not despite the crash, but because of it. The usual advice in a downturn is to hide in cash, maybe buy some gold, and simply survive. The argument here is different. Crashes do not just destroy wealth, they transfer it, and they tend to do it through the same 5 channels again and again. The first asset class is long-duration U.S. government bonds. Most investors treat bonds as dull, but during a real economic breakdown, long treasuries can become one of the strongest performers in the market. The mechanism is straightforward. As the economy weakens, central banks slash interest rates, and they usually do it fast. In 2008, the Federal Reserve cut rates from 5.25% to effectively zero over 14 months. In March 2020, it cut by 150 basis points in a single emergency weekend meeting. When rates fall, existing bonds with higher fixed coupons become much more valuable. In 2008, while the S&P 500 fell 38%, the iShares 20-plus year Treasury bond, ETF, TLT, rose 33.8%. During the Great Depression from 1929 to 1932, long-term U.S. Treasuries posted positive returns in every single year, while stocks lost 89% of their value. The reason is deflation fear. When credit contracts and prices stop rising or begin falling, fixed cash flows become more valuable and capital floods out of risk assets and into sovereign debt. In the 2020 COVID crash, TLT rose about 25% in less than 6 weeks, while stocks fell 34%. The key window opens when deflation fear replaces inflation fear, and credit markets begin to seize. It closes when central bank intervention starts reviving inflation expectations. The second asset class is volatility itself. Most people never think of volatility as something they can own, but in a genuine crash, it can become the most explosive instrument available. The VIX measures expected volatility in the S&P 500 options market. In calm markets, it usually sits around 12 to 15. In late February 2020, it was near 14. By March 18th, it hit 85.47, a 507% increase in 6 weeks. In October 2008, it reached 89.53 after starting the year near 20. These are not normal price moves. They are violent repricings of fear. Investors can access this through exchange-traded products tied to VIX futures, including short-term products like VXX and leveraged versions like UVXY. The catch is that these instruments bleed value in calm markets because of contango, which is one reason mainstream advisors rarely recommend them to ordinary investors. But professional money managers do use volatility protection. Paulson's famous 2008 trade was essentially a bet that mortgage market risk and volatility were being priced far too cheaply. He bought protection when the market was calm, and when panic hit, that protection exploded in value. Volatility is not a passive holding. It is a tactical asset meant for a narrow window when credit conditions are breaking down, but before the broader public fully understands what the options market is already signaling. The third asset class is distressed debt. This is where some of the biggest crisis fortunes have been made, not by stock investors, but by credit investors buying debt from forced sellers at prices far below likely recovery value. In a crash, banks face margin calls, hedge funds face redemptions, and insurers run into regulatory constraints. They sell whatever they can, often without regard to fundamental value. In March 2020, even investment-grade corporate bonds sold off hard. The iShares iBoxx investment grade corporate bond ETF LQD fell nearly 20% in 3 weeks, despite holding debt issued by fundamentally sound companies. From the March low to December of that year, it recovered about 25%. High-yield debt moved even more sharply. The iShares iBoxx High Yield Corporate Bond ETF HYG fell about 24% in the crash, then rallied to new highs within 7 months, producing roughly a 40% move from low to high. The larger gains in past crisis cycles came from buying individual debt directly at distressed prices. After 2008, institutional investors bought mortgage-backed securities at 20 to 40 cents on the dollar, even after accounting for elevated defaults. Investors who bought at those levels and held through recovery often made several times their money. Howard Marks of Oaktree Capital wrote in October 2008 that the opportunity set was the most compelling he had seen in his career, and Oaktree's distressed debt funds launched in 2007 and 2008 later produced annualized returns above 20% over the following 5 years. Similar patterns appeared after the Latin American debt crisis, the Asian financial crisis, and Argentina's default. The signal is usually the same. Spreads blow out to levels that imply systemic insolvency far worse than reality. The trade is to buy what panic prices, as if civilization is ending, then wait for fundamentals to reassert themselves. The fourth asset is gold, but not in the way most people think. Gold often does not protect investors during the most acute phase of a crash. In fact, it can fall sharply. In 2008, gold peaked near $1,000 per ounce in February and dropped to about $720 by October, a 28% decline during the worst financial crisis in decades. Anyone who bought gold before the panic and sold into the October low did not get protection. They lost money. Gold's real function shows up in the phase that follows the crash, when governments respond with money creation, rate cuts, and balance sheet expansion. From its October 2008 low near $720, gold climbed to about $1,900 by September 2011, a gain of 164%. That move came after the crash low, not before it. The mechanism is simple. In response to a breakdown, governments print. After 2008, the Federal Reserve expanded its balance sheet from roughly $900 billion to $4.5 trillion over 4 years. In 2020, it expanded from about $4 trillion to $9 trillion in just 8 months. When the money base grows that fast, each unit of currency represents a smaller claim on real assets. Gold cannot be printed, so it tends to reprice upward against the currency. The same basic logic appeared in 1933 when Roosevelt's executive order 6102 was part of a controlled dollar devaluation against gold. The lesson is not that gold is the perfect shield before a crash. The lesson is that gold tends to work best when central banks begin reacting. Real rates turn negative, and panic selling temporarily disconnects its price from its monetary role. The fifth asset class is farmland. Between 2007 and 2012, the median U.S. home price fell about 26%. Commercial real estate in major markets fell 30 to 40%. A diversified stock portfolio was cut in half. Yet over that same period, U.S. farmland values rose about 30% on average. In Iowa, farmland was worth about $3,900 per acre in 2007 and roughly $8,400 per acre by 2012, a 115% increase. That is not a quirk. Farmland is not just real estate. It is a productive asset that generates output regardless of what the financial system is doing. A soybean field does not care whether an investment bank survives. It produces soybeans, and people still need food in a recession, a credit crisis, or a depression. In periods of economic stress, food security becomes more important, supply chains weaken, and food price volatility rises, while demand remains basically inelastic. People can postpone buying a second house. They cannot postpone eating. Even in the Great Depression, debt-free farmers who owned productive land faced a fundamentally different reality from urban workers. Farmland is also the most independent asset on this list. Bonds require functioning central banks. Volatility products require functioning derivatives markets. Distressed debt requires courts and restructuring systems. Gold requires global price discovery. Farmland requires soil, water, and biology. That does not make it risk-free. It is illiquid, location-specific, and exposed to political risk. Zimbabwe's land redistribution program showed how quickly ownership claims can be destroyed, even when the land itself remains productive. Structure matters as much as the asset. Debt-free farmland in a stable jurisdiction, especially when tied to export crops priced in hard currency, can be one of the most durable forms of productive capital in a crisis-prone world. The larger point is that money lost in a crash is not simply erased. It changes hands. It moves from the unprepared to the prepared, from reactive investors to structurally positioned ones. Long-duration bonds rise when deflation fear takes hold. Volatility instruments explode when panic hits. Distressed debt appears when forced sellers dump assets below recovery value. Gold often lags the crash itself and then surges on the monetary response. Farmland can keep compounding quietly while the financial system around it is under stress. The investors who profited most in 2008 were not necessarily geniuses or insiders. They were people who understood the mechanics before the headlines arrived. Every crash is called unprecedented by the people it destroys. To the people already positioned for it, the pattern usually looks familiar. The real question is not whether another crash will come. It is which side of the transfer you will be on when it does.
Thanks for watching. If you enjoyed this video, please leave a like, subscribe to the channel, and share your thoughts in the comments. Stay informed, stay rational. See you in the next one.